I'm Janet Noak.
And I'm Andrea Dillon. We are a mother-daughter CPA firm serving the United States business community with tax preparation services, tax planning, tax resolution, assurance and audits, and CFO outsourcing and consulting.
Thank you for listening to the WOW podcast, Words of Wealth from CPAs of Florida. Learn more at cpasofflorida.com or call us at 239-936-6144. Today our topic is going to be tax return gotchas. I sold my house, now what? Andrea, do you want to talk about a principal residence?
I do. So for those of you who aren't 100% sure what principal residence means, it means the house you live in. It's your home. When you sell it, you have to tell the IRS, the title company is going to tell the IRS that you sold it. So there's a really, really great exclusion that was just extended for principal home, for the sale of your principal home. So when you sell your principal home, if you are married, you have up to $500,000 of gain that you get to exclude, i.e. not pay tax on. If you're single, that drops in half. So if you're single, you have $250,000 of gain that you get to exclude from your income. The caveat here is that the IRS doesn't know that unless you tell them. So you may be saying, yep, my gain is way less than that. And really, when we're talking about your gain here, we're talking about what did you buy it for? What big things did you improve on it? Maybe you put a pool in, maybe you put a new roof on, those big expenses that stand out in your mind. Not, hey, I put a new door handle on my bedroom, but hey, I replaced every single door in my house. That's a big thing. And then what'd you sell it for? So I sold it for, $400K. I bought it for $200K and I put $100K into it. Simple math here, that's going to be $100K left over as gain. And that is well below my $500,000 limitation. So that means, yay, I get my money and I don't have to pay any tax on it. But the IRS doesn't know those numbers if I don't tell it to them. And if you forget to put it on your tax return as such, and the title company sends a 1099 to the IRS saying that you sold your house for $400,000, you're probably going to get a love letter from the IRS requesting that you please fix it and probably asking for a lot of money in tax due. So that is kind of a big deal. The other qualifying factor for this is that you have to live in the house for 2 of the last 5 years. So I can't go buy a house, live in it with my husband and my kids for the next year, sell it, make a bunch of money, but less than my $500,000. Maybe I made $100,000 profit when I sold it a year from now. So I'm well below that $500,000 limit that we spoke about. But I didn't live in it for 2 years. I only lived in it for 1 year. So that means that entire exception where we don't have to pay tax on that gain goes away. You have to live in it for 2 of the last 5 years. Now that means that you can live in it for 2 or 3 years. You can then move out, buy another house, rent, wherever you want to go. You can rent that house out for 2 years and still have time to sell it. You just better be darn sure that you are able to close, not when you list it for sale, you are able to get a buyer and close where you can still say, yes, I lived in that house as my home for 2 of the last 5 years. We had a client about a year ago whose real estate agent advised them differently, and they sold it, closed, signed all the documents at 1 year, 11 months. They were 1 month short of meeting the 2-year goal. And that meant that we had to have them dig through lots of records to find all of the improvements they had done to that home so that we could try to mitigate as much of that gain as possible. And if they had just stayed there for 1 more month, they would have met the 2 years and they wouldn't have had to pay tax on it. So it's a really, really big deal. It's a really great exclusion. And a lot of people really don't know about it. We get that question all the time. I sold my house. I walked away with some money. Do I have to pay tax on it? What do I do with it? So again, if you are married, you get $500,000 of gain tax-free. Single, you get $250K tax-free, but you have to live in the house for 2 of the last 5 years. Again, that's your home. That's where you live. So what about when it's not your house? I mean, it is your house, but you don't live in it all the time. Maybe you have a second home, you have a vacation property, and you're wondering how that affects you on that house. And Janet's going to talk to that topic.
I am. We're going to talk about what about your second home. So, first definition I want to talk about is what exactly is a second home. So, every home has to have sleeping quarters and every home has to have a toilet. So, what does that mean exactly? That means that your house, of course, meets that criteria, but maybe your motorhome meets that criteria, or you have a boat, or a yacht, or a camper. All of those can meet that criteria to be a second home. So that means a lot of different things in the tax law. You can be able to write off interest on those. There are a lot of benefits to having a second home. Now, sometimes that second home is something that just you use. So for instance, if you live in New York and you buy a second home in Florida, then you go to sell the second home in Florida and you have a gain on that home, that ends up being a taxable gain. So you would pay current capital gains rates, which right now are around 15%. That could change though. But the bigger question comes into play. What happens if I own a house in New York and then I retire to Florida, but I keep my New York house and I lived in my New York house for 30 years, and then I retire to Florida, and then 3 years later, or 5 years later, go to sell my New York house. It might not be my primary residence anymore because I've been in Florida for 5 years. So all of the gain on that house in New York would be subject to tax. So if you owned it for 30 years, some of the higher growth areas, such as maybe Rhode Island, the coast, New Jersey beaches, if you have any of those properties, you might have been able to get $500,000 tax-free, but because it actually converted over to being your second home, you're going to have to pay tax on that gain. So that's something that you should strategize for, because once again, you're only going to be able to have the costs that you paid for it, plus the improvements that you did to the property, and then you're going to pay capital gains tax on the difference between that and what you sell it for. So that's something that you should work through with a professional advisor before you actually put the house on the market, or maybe do some strategizing as you're getting close to the either 2 years or 5 years of the time limit. So any questions on that, Andrea, or anything you think we should clarify?
What if somebody has two homes? So maybe they live in Florida, because we here in South Florida have lots of retirees down here. So talk to the listeners who have a house in New York, a house here, a baby yacht here, and maybe they have a condo in the mountains somewhere too. So, and they want to sell, maybe they have a really big loss in one of them because they bought it at a really, really high market. So one of them's going to have a loss. One of them, maybe they're going to make some money on. Can they do some strategizing and tax planning if they sell them at the same time to help offset it?
Well, that depends. So for instance, no matter what you do, a personal use property is a personal use property. So let's say that the house in the mountains has a loss because maybe a tragedy went through there and they lost a lot of value on the house. If they go to sell that property, if they've only ever used it personally, they're not going to be able to take that loss. Now, if it's been an investment property, such as a rental property, that's a topic we'll cover in another podcast. But basically, if it's a personal use property and it has a loss, they don't get to take any of that. So if they sell a property with a gain in the same year, it's not going to help them at all. So you want to talk to your tax advisor and make sure you're on the right page to get that done correctly.
And if you have any questions about properties that you want to sell, you can reach us again at www.cpaoflorida.com, or you can call us at 239-936-6144. I'm Andrea Dillon.
I'm Janet Noak. We are CPAs of Florida.